Howdy, Jacob here. Today we're looking at Jakks Pacific, ticker symbol JAKK, company 62 of our high ROIC screener, 242 million market cap, 146 million enterprise value. So pretty small company in the leisure products industry, founded in 1995. It looks like they design, produce, market, sell, and distribute toys and related products for indoor and outdoor. Okay, interesting statistics. Let's look at their insider ownership, 28%. Okay, so good amount of insider ownership here for companies as small as this. You really want to see, management and the board have some skin in the game, which it looks like they do. I like it to be over, in the double digits at least if it's a sub billion or sub $500 million company. So that's a positive sign. Earnings is kind of all over the place, so we'll have to look at the income statement to see why that is. But we see as high as $8.86 a share, $7 a share, down to negative 24, negative 39, negative 21. So they might be doing some things on the earnings side. Hopefully, their free cash flow is a bit more consistent. But on the gross margin side, we are seeing relatively consistent in the range of 25 to 30%. It's just that operating margin. So those expenses post cost of goods sold are interesting here. So sales and general admin has actually decreased with how much inflation is. That's interesting to see that. Total other expenses, okay, yep, down. Net interest, no. Other non-operating income, okay. So there are some weird periods where there's some other non-operating income more than offsetting the operating profit, which leads to the pretty volatile net income. And then recently, shares have been exploding. That's not great. So cash. Let's look at the balance sheet. Cash on hand, 85 million. Well, 85 million cash on hand, and short-term and long-term debt of less than that. So very positive balance sheet. On the free cash flow side, if you look at the last year in the rolling 12, you're looking pretty fantastic. And it looks like they're using a lot of money to pay down debt. They're not really using a whole lot of for acquisitions, reinvestment, a little bit, the babyest amount, repurchasing shares. Stock-based compensation at $8 million. So that, I guess it makes sense why insider ownership is so great. There's definitely options for management and executives to get a lot of shares. So there's a balance with it, right? You want there to be good insider ownership, but you don't want them to be handing away so many shares that you're just getting diluted as the owner to where instead of owning 10% of the business, obviously, if you own 10%, it's crazy. But if you own 10% of the business and they double the shares, now you own 5%. So you just don't want them to be, in the majority of cases, unless their growth can really outperform that increase in shares, and they absolutely need that funding for certain purposes, then it's usually not advantageous to be increasing shares, even if it is going towards executives to where you're more confident in them doing the right thing, because that just leaves you with a smaller piece of the business. I'm going to be a little bit skeptical on this growth of the last 2 years due to the fact that it wasn't due to acquisitions. It wasn't due to reinvestment. I feel like there was just some high demand for it. And I mean, yeah, even here you can see it dropped off relatively quickly, about 10% from last year to the rolling 12. So that's not super positive sign. I'm going to be pretty hesitant on these numbers. Although this is the high ROIC screener, we can see that rolling 12 looks, to me at least, like it's kind of an outlier, and I would not be surprised if it were to fall back into a more cyclical earnings and not necessarily this extremely great $8 a share type thing. With them increasing shares so much, I mean, I have to assume that at least 10% increase in shares is going to be the case. And then I'll probably just do an average inclusive of these zeros due to the fact that, I just think that sometimes they'll be negative, sometimes positive. It'll average out in the end. But yeah, this is not it looks very deceiving with this 2.8 price to earnings, and that's why it's very informative and important to do your own research on the stock to see in the company to see whether you think that these numbers can sustain or not. Personally, I don't see the sustainability quite there. I do think that the balance sheet is very attractive and that enterprise value is awesome, but everything is the price you pay for it. And here, I just don't think that the cash flow generation is going to be enough, especially with them diluting shareholders as much as they have been. So hopefully you enjoyed the video and have a great rest of your day. Thank you.